Not yet, not yet, not yet.
What? Are we live?
Wake up, buyer payer people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhoads on the Buy Here Pay Here Morning Show. Take it away, you two.
Good morning.
With over 200 episodes, I still do silly things like going live, and it's like, no, not yet, not yet.
She stopped. She gets a little out of order. I asked her if she needs more coffee this morning.
Apparently so, for crying out loud.
All good.
Yeah. So I mean, you know what I aim to do is to create a little bit of comedy relief for the day.
Oh,
it's
good
a
job.
Friday.
Good job.
You're welcome.
Yeah.
Well, welcome everybody.
Glad
it's
to have
Friday.
you here on a Friday. We're talking about some really important stuff today. And I told Michelle this morning, I think we'll just have to make this an ongoing conversation because you can't possibly cover it all. You kind of have to go custom when it comes to these kind of cash flow things. But
we don't really have many on the announcement side, except
just a reminder about the V8 group on Tuesday night. We still have
new
seats.
Dealers.
Yeah, we have seats for the new dealers who are, if you're generally 100 accounts or less. And so we're happy to have just brand new folks. So just reach out if you're interested in getting involved in the V8 group. And our group one is about full. I think we've got enough contracts out that we have those signatures come in. I think group one will be full, but we're happy to create another group and make room for some more folks that mostly that group is established. The group one is roughly 200 to 300 accounts. So that's kind of what that one is. But shall we get the other announcement? Just remind everybody, February 15th, the dealer roundup.
Yes.
Right? That's Thursday morning.
February 15th, dealer roundup morning.
New format, basically 3 dealer panels.
It's kind of, if you guys have been with us for the last year, you know that this is something that we do. It's usually like the full day live broadcast, but we're cutting them down to not quite as long so that it's a little bit easier for people to be able to attend and enjoy. But there will be the recordings available after the event, and if you put it on your calendar, then you can ask questions during the event and, be able to participate in that kind of way. So, and good morning, Jared Halstead.
Yeah. Good morning, Jared in Arizona.
Yeah.
Glad to have you here.
Happy to have you.
Somebody says hot topic, and it is. This is an important one.
I think not hot topic.
Yeah.
Hot.
Yeah.
Quadruple. Yeah.
Muy caliente.
Right? Muy caliente.
Yeah. So we got Mr. Sam Epstein standing by. Let's bring Sam in and say hello.
Hi, Sam.
Didn't get a chance to connect ahead of time. So through your audio.
Hey,
good morning.
How are y'all doing?
Good.
Very good. Thank you. We're glad that you joined us today. And you're the one that stirred a lot of really interesting conversation.
I find it fascinating, Sam. Obviously I said that so Sam, for those who've not met him, and we just met him yesterday. I had a chance to have a phone conversation with him last night, but he put a really interesting post out on the BHPH Success Group, which for those of you not familiar is a private,
shout out to
private BHPH or private group for buy here, pay here, and lease here, pay here dealers. And so Sam put a question in there that is something that we talk about a lot, Sam. We work on cash flow modeling for dealers that are new. And I thought your question was particularly interesting because you were basically asking about how much free capital should I need? And you can share your interpretation. I thought what you were asking is, if I used leverage, how much of my own money would I need to be able to get over the hump? Is that correct? Is that paraphrasing correctly?
I mean, yes, basically we're a family business. It's me and my dad and my sister. And we were having a conversation. I was talking to my dad about, if let's say one of us wanted to open another lot, or if we wanted to open, just expand, just kind of theorizing, hey, how did we get to where we are? We're a one store location. We've been mature for a while now because our business opened in 99. And so we've been hovering at the 400 to 500 account range for quite a while. And partly we can't get much bigger because we're on a 0.3 acre lot. So it's hard to get, there's only so much you can grow with so much space. I mean, people do it more, but it's a lot harder when you're limited in space. So, we were like, at some point, sometimes you actually start accumulating capital, but you also are like, well, how did we get to where we are now? And if you were, to open another dealership from scratch, the question is how much money, in my mind, was what would you need to have a high chance of success? Yes, you could use leverage, but obviously if you start out with, there are a lot of dealers that fail. So if you start off with $50,000 or $100,000 and, all you can afford is some inventory, and you try to put 10 notes on the books and then immediately have to start selling those notes or borrowing against them, you're putting yourself at a lot more risk. You get to 250,000 or 500,000, in cash you can invest in your new venture. Okay, well, you may still need to borrow money, but at least you're coming in with more equity to where you have, some of that financial padding that you don't have to have everything go right immediately, from month 1, month 2, where it's, hey, if I'm not profitable by the second month, I'm out of business.
Sure.
Well, because everyone knows with the new business, if you don't start making money at some point, you go under.
Yeah. And what we'll be able to illustrate here today, and we don't look in the modeling that I brought together for today, we don't look very much at the profitability. Like, we certainly can look at the profit side, but as you know, in this business, unless we're selling the paper, we can't really leverage that profit, or if,
sure, cash flow
that paper. Right.
Yeah.
So we're really looking heavy at cash flow. And I think what I said before you joined is that I think we're going to have to kind of do this at an ongoing conversation. In fact, till further notice, I'd like to just make every Friday episode around this subject, because what I'd like to be able to come back and do on a future episode is break it down like what it would look like organically. Like if we just reinvested the cash that we generated on a positive basis, and kind of just compare side by side. For today, I just kind of took typical dealer doing 25 a month, and what's that look like? So we can get into the numbers.
Yeah. I had one thought as you were talking about that. You've been in the business since 99, did you say?
Well, I came a couple of years after. I'm going to be 40 this year, so I'm 39. So a couple of years after, but not many. Early 2000s. Yeah.
Well, so
about years now.
The thing the first thing that came through my mind, and again, I'm married into Buy Here, Pay Here, so we talk about it all day long, every day. So I've learned a couple of things, but back in 99,
cost of car
was like $3,000.
Yeah.
And today it's like 10 grand. So it's triple.
That's true. That's true. However, and I think you can see it many different ways. And there probably are, there's thousands of Buy Here, Pay Here dealers out there. So, there's upsides and downsides to everything. I mean, in some ways, we've had some of our better years more recently. And partly it's because also the cost of selling a car is higher now. Back then, you're going to have a lot of people asking, hey, can I get a $200 a month payment or $250? Nowadays, people walk in expecting, hey, I need a smaller car payment. And they're saying, I need around $400 a month.
Right.
That's a smaller payment today. So, sell a car for 13 or 14,000 is not unreasonable. And I would say, the margins aren't necessarily. I think during COVID, when there was that shortage, it was a lot harder. But now, when there's the availability of inventory, that comes back on, on market, and now it's a more normalized situation.
Yeah.
There's dealers who are buying those $10,000 cars, but they're still, I see them all the time, $6,000, $7,000 ACV ready to go cars, and you can sell them for 13 or 14,000. You couldn't sell a car for 13 or 14,000 back in 99 or 2000 either. So
No,
Yeah,
but I mean, $100,000 though would go a lot further.
yeah,
Yeah,
yes,
than it
yes.
would today.
but
So
you also
yeah.
had lower overhead, maybe expected lower profits. So yes, the dollar, there's been a lot of inflation. Let's just say that.
Yeah, and I think for today we're going to deal with numbers. Like not much speculation. We have a lot of, some call it levers, like in this cash flow modeling. And if you want to show it on the screen, Michelle, we can go ahead and move to the numbers, because and don't anybody panic when they look at these numbers. There's a lot of stuff to understand about what we're looking at here. But
I'm actually going to just make this full screen so that everyone can see it a little bit better. And
and listen, there's so many different levers, so many different assumptions that we can change. All those numbers in yellow, we could change as assumptions that drive the stuff. And for this morning, Sam, I brought together some other assumptions that we can plug in, so we can turn a line of credit on or off in this scenario. We can also turn the related finance company on or off. I can tell from working with the modeling, at this volume, at this cost of a car and price of car, we kind of have to have that related finance company, or we really just get, hammered. So we got to look at how these are big numbers here, but I thought also fascinating, Sam, that when I read through the comments on your post, they were all over the place in terms of what people were saying. And this is why I think it's just so important let's just break down the numbers. Let's not speculate and guess. Obviously, business models vary. Pace of sales is going to make a big difference, volume, and then, how fast you want to grow that volume. All these kind of things are big factors, and why those answers would be all over the place. But I just think one of the things we've challenged everybody to do across the industry is we just ask, when we talk numbers, let's be as specific as we can so that everybody can learn from it. And so what I'm trying to do here is, drill down to certain numbers. And Sam, your numbers in Texas would be different. Like I'm sitting here to look at the numbers for those who aren't able to see the screen. Some of our folks catch this on audio, after the fact. So, we can't go through all the numbers on the screen, but basically what I've got currently loaded is a selling volume of 25 a month. And for this model, it assumes you do 25 a month from the very first month. And we know that's not exactly how it works. So again, we're trying to get an overall projection of what kind of capital would be required, if we were to operate at this level. So let me kind of go piece by piece here. I've chosen, so the numbers that you see in orange over there on the left, those are numbers that we've taken from our V8 dealer group, so that we've just got some real averages from some real dealers from the month of December. And so these are numbers that obviously we can change them, and you and I can change them today, Sam. At the end, as we get back to the end, we can move some of these numbers and get a feel for, how it moves the needle. But I currently have 23.9 in for the APR. That'll vary by state and what the cap is going to be, and obviously by business model. I have some add-on costs in there, and those get financed. And obviously, Sam, your case in Texas, you have the seller finance tax program, so you don't have as much sales tax up front, or some of these other things that would drive some of these numbers up, with a typical dealer. But since more of our dealers complain about not having a seller finance tax program, like Texas,
definitely a big plus here in Texas.
It is.
A lot of money on the cash flow.
Maybe between you and me and Michelle, we have enough stroke to go get some of the other states to do it too. So Michelle's got a lot of influence. She's charming. So but yeah, that is a huge benefit for you. But I've got the cost of car I've got loaded in for those who can't see the screen. We're at $82.45 for a cost of vehicle, including recon.
And selling price is just over $14.5.
Right. So you got that number in there, and we currently
non-round numbers. Like you didn't say 14,500. It was like
I used actual average.
These are the actual average from dealers that we talked to. Yeah.
So just kind of saying, this is what it looks like for our dealers across, it's across many states. And so I'm just trying to give something that's representative. I used $520 payment per month also from the group. This number doesn't drive much in the big calculations, but what it does do is give us some of these numbers down here in green, which we may be able to get to and explain a little bit. It gives a snapshot of receivables down here. This shows that at the end of one year, we'd have 3.2. At the end of 5 years, we'd have 6.1 in receivables. So it does kind of give us a look at receivables. And I've got the RFC toggled on right there. If I put in 100%, it will take away the impact of the RFC, but the numbers go through the roof. And so
do you have an RFC, Sam?
We do not. And
Yeah.
strangely, we grew fairly slow.
Mhm.
And because of that, we never needed it. So
Yeah.
we don't have the overhead from it. Also, once you get to the mature level, it's almost pointless to have. But
Yeah, it's interesting to hear you say that, because that's something that we sometimes comes up. I always feel like the optimal benefit from RFC is early. Of course, dealers enjoy discounting the contracts every year, but you're right. As a portfolio matures and now you're experiencing the losses from prior year's sales, then your profitability is not what it was, and so you don't have the same problem. And you're right, slow growth, you would have less.
I think that you get it. It's only as you're growing that you get any IRS tax benefit is the thing. So if you're not growing, you no longer receive any tax benefit from it.
Yeah, I follow, because it's true. You would be writing off, those prior losses or your prior charge-offs or prior sales that are charging off in the current period. Maybe a better way to say that. But let me kind of go over to these numbers on the right side in pink right here. Those numbers are your cash flow, and this includes income tax. So it's allowing for income tax of the dealership after allowing for the RFC discount. So what you're seeing is that in year one, we would need, at this volume, at this cost of car, at the down payment, which I've got $1,386 loaded in there for down payment. Some dealers enjoy more. And so again, we can come back and rework model after model with this thing, but we just kind of pick some representative numbers. And this thing would be negative, Sam, 2.8 million at the end of 12 months. And I've got an analysis, a breakdown of that first year. So let me just go through those. So you can see over there, we've got our startup costs, which is it's startup money. So it's spending in kind of what I call the pre-start month. Like it would be whatever operating expenses you would have to get your store open. Then you would have initial inventory included in that too. And I think I set it at 20 or 25 units over there to start. So we'd have that cash before we ever started conducting business. Then in the first year, we would have this much spent purchasing and reconditioning cars. We would have our, and I think that number includes it includes add-on costs. Then you've got operating expenses there. Down payments, now we get into the positive numbers, thankfully. Down payments and car payments coming in, and repo ACV recovered. Now, I'm using some what I call conversion rates that are typical for our dealers and out there. And so those conversion rates drive the way the portfolio converts to cash, which, those numbers could be expressed sort of as a collateral recovery rate, which many of us hear about. But bottom line is those numbers are reflective of at the rate at which dealers typically collect. And so now that's kind of a breakdown of all the cash. So incoming cash in year one, 1.6, negative cash, 4.4. So we're at 2.7. So obviously the cost of funding all those $8,200 cost cars minus $1,300 down payment, we got a lot of cash going out on the road in that first year at this pace of 25. So again, for just a little bit, I want to leave all those numbers locked down because we've still got a few more things to talk about. And I've got the line of credit loaded in here down at the bottom. And so I can turn this part on and off, but basically right now, if we had a line of credit, now I got to be super careful about the way I say this. This is what I chose to do here is something that really is pretty difficult to do. It really just basically utilizes a line of credit from the beginning, which most dealers can't qualify for a line of credit right out of the gate. So that's kind of problematic in our modeling to begin with. But I just kind of, for instance, I said, if we had a line of credit and we could borrow against our receivables from the gate, then we would have, and I used a 50% leverage. So let's just kind of walk through that for everybody. What I use is a 50% advance rate on principal. And I can take us over there and show you how I did it. But basically I just said, if we drew 50% on every new contract, then I figured out how much of our principal that we collected from consumers would we have to apply to that line of credit to keep us under a 50% leverage. And so that's the modeling that happens here. And it just said, but that again assumes that we started borrowing from day one and drew that money on the line of credit. So now at the end of 12 months, we would have almost 1.5, and if people can read that number, 1.472 that we would have in debt at the close of 12 months. And this is currently, I've got it modeled out at an 18% interest. Now we can play with some other numbers because again, typically the only way dealers are going to have a line of credit right out of the gate is it, and I don't want to speak on behalf of any of our lenders out there in the space, but typically they're not going to provide financing inside of a year. You know, they want to see some history. They want to see some cash flow and receivables.
So in Sam's, in your scenario though, like if you were to say that what we want to do is we want to open up another location, and starting this as another location, you have all of that path.
That's a possibility, but for my question, it was really if you're starting fresh, like not with the ability to leverage your current location, because for one thing, let's suppose you want to split off a family business or whatever, or you just don't want to, you want to form two corporations and you don't want to risk the first corporation taking any risk on that. Hey, I don't want to risk my first dealership at all for my second dealership. Just theoretically. I'm not saying you can do it without that, but because obviously they may say, hey, we need a personal guarantee or whatever. But just the theoretical idea.
If you had the money and you could,
how
much
do you need to restart? And I do. There's an interesting spreadsheet here. I think the only thing I'm a little lost on was like 5 and 6 on the lines. I wasn't real clear what those lines were.
Oh, that's just add on. I'll take you down and show you. Let me just show you.
I think also, part of that idea of kind of the organic growth is also the bootstrapping yourself and being a little bit on the more frugal side.
Sure.
I'm not saying people always want to do that, and obviously a lot of it depends on where you are in life. Hey, am I willing to work a little harder, a little smarter? Or can I not? But like I noticed, like overhead was 1.3 million from day one. I imagine probably a lot of dealers try to get that number somewhat lower when they're starting out. And eventually, as you mature, it's like, well, now I'm in a more established space, and maybe I don't want to work as hard, so I have a couple extra managers or whatever. I don't know what that number, that 1.3 million was, but it certainly doesn't sound low as far as
it does.
overhead.
Let me tell you where that number came from. Back
your group, right? It's from your group.
That one is not from our V8 groups. That one is
so we don't do expenses in the V8 groups. So this number actually came from an appearance when Brent Carmichael was with us from NCM a few weeks ago. He brought the third quarter averages from there. So what this number is the small volume dealers, and it was the benchmark average of their small volume dealers. So
you can see right there, it's highlighted. It's line 21.
And that's, I'm sure it's a legit number. It doesn't seem not legit, but I just think, it's different when you've got 500 accounts and you're already mature, and you say, you know what, now that I've established my business, I can afford this overhead, versus when you're starting out and you say, I'm just starting, so I don't have that money. What do I need to do to get to the point of
course,
of having that kind of money?
And that's why this will have to be an ongoing conversation, because everybody's approach is going to be a little different. So I would like to look at an organic kind of slow growth scenario on a future podcast, because this number, and you're right, this number is basically it's overhead per car sold. So I'll use the benchmark instead of, I think the number was 2602 right here. So if I change that number, now our overhead we're at 923. So that's model dealers. That's like, that's the benchmark for typical dealers are spending $2,600, or the benchmark dealers in NCM's group, just hundreds of dealers, are spending about $2,600 per car sold. So that's how that number works. And again,
does that include that sales tax number? I'm sorry, I don't mean to.
No, help yourself.
Sales tax.
I was like, I didn't even know where that number was. I heard you say it, and I'm like, well, since we are in Texas, we don't deal with that.
No, here's where that comes from. It's down here. I'm using a 7% sales tax rate. So that says each deal would be about $1,000. And by the way, for you outside the state of Texas. Sam in Texas still has to pay a sales tax. He just gets to pay it as the customer pays instead of having to cough it up front. So up front,
that's a huge thing, because if they stop paying, we stop paying the sales tax.
Absolutely,
as well.
absolutely huge.
Yeah, and that's not recouped in other states from dealers.
We should probably quit talking about that, Sam, because you're gonna have a lot of dealers moving from Illinois to San Antonio wanting to set up their dealerships down there, and so you're gonna have a lot of competition. No, it's a really great thing. And a quick mention of I'm told that Ken Dunnigan, is that his name? That doesn't sound right, but Michael Dunnigan out of Texas. Yeah. So he's gets a lot of the credit, I'm told, for helping put that together many years ago. So yeah, to his credit, you guys have that solution. So that's something that we are aware, but I've got it modeled in at 7%. So just the sales tax alone per deal would be $1,021. So we got to cough that up in 30 days. So that math is included in the cost of sales up there above. But yeah, that's where those numbers are coming from. And so it's inside this purchasing cost of goods sold, because we're only paying that if we're selling cars.
And then you had asked about the add-ons, what it is that we're talking about.
And that's what that is. That's sales tax plus I think it's got $135 for other costs, like, registration plates. Obviously that varies by state and whatever, but
so that's a big expense for a lot of states, which I mean, on the other hand, when you're dealing with that, well, then you're on a level playing field with all the other dealers in your area as well. So
yeah. And I might add too that this operating expense up there currently has the interest associated with this line of credit that I have turned on. If I turn off the line of credit and I don't pay 18% interest, now my operating expense drops to $780.
Okay. So there is. I was wondering how was 1.3 million. So a big part of that is
interest
on your line of credit. Okay. Mm-hmm. And that number sounds a lot more like, well, how did you jump up to 1.3 million from the year?
Big number.
Okay. But the interesting thing that I when we were looking at this before is that having a lock or having a line of credit and not having a line of credit is only a few $100,000. It's not a lot of.
Sure, I know what you mean.
Well, when you change.
I mean, your success or non-success isn't going to be tied that much to that other than for the factor of whether or not you have access to that money.
Yeah.
Right.
Yeah.
If you get your line of credit cut off or you can't get one, then that's a problem. But once you have it, it's not like the number one thing to your success of your dealership.
Sure.
Because you can make up that 300,000 in a lot of ways.
Sure.
You get your unit cost down, or your overhead costs down in other ways, or your payment. If you can get your payments higher, or your relative to your cost of goods, I mean, that does make a big difference.
Sure, absolutely. And I think volume, obviously, if we slow down the volume, which we can start flipping some of these levers now that we've kind of given everybody a tour of what they're looking at. I don't know that I quite finished over here about, I took out the line of credit now. So our difference between when we say free capital, like how much cash would I need currently at this volume of 25, not using any external debt or capital from outside, at that volume and at this APR and all those numbers that we have locked in, then you're at about 2.2 in the first year. I'll point out that you're actually negative 2.5 in total. And that's because we must still be going slightly negative, as you can see, into the early months of year 2, because we're still total negative of 270 for the second year. So that just means we're not quite there in terms of our 2.2 at the end of the year. But I just wanted to model out the first year, because that's really the critical period for folks. And you can see why it's challenging for people to get over the hump, if they don't have enough cash. And again, we've got cost of car in here from some dealers that are established. So obviously that, so people talk a lot about different costs of car and what that translates into performance. And I think you have to be careful about those kind of things. But I think if I move the numbers over here, let's just look, if I could do a $6,500 cost car, and let me just carry that across the way, and I could drop that selling price now to, let's put $5,000. If we do 11.5, just to a starting point, if I put 11.5, So let's say this is more representative of what I'm going to do. And let's back this volume back down to 15 a month and do that across the way. Then you can see how much the numbers are going to shift. Interestingly, though, we're at 1.5 now, still for the first year. I've still got our overhead is still being driven based on volume. So as we dropped our volume, we would have also dropped our total expenses. Now our total operating expenses in the first year under $500,000, and our cost of that is down. But we still need 1.2 in the first 12 months to get, and we're still not quite cash positive. So we need 1.419 to get ourselves cash positive on all the cash that's moving in the business.
But that's a big difference. It's $1 million difference.
Absolutely.
When you switched it to 6,500 from
absolutely.
80
Huge.
to 8,500.
And now
I'm curious, like, what have you, could you move that number to say selling price to 12,000 from 60, maybe you can get a little bit more margin. Would that make a difference?
It will only move I
don't know how that affects it.
It's going to move our profit, which is going to increase our income tax a little bit. So that's about the only thing that would move in there. Again, keep in mind, as we look at this, I've got a 30% discount to the RFC built in there. So that is reducing our profit on the dealership side, which is reducing the demands of income tax, because income tax is rolled into these numbers. I put up here, this is post-tax, but doesn't factor in the leverage element. So I
think it lowered the number a little bit, though, on the free capital.
On which one?
On the free capital.
The free capital net of debt. I think it was a little bit higher.
Okay.
It was 12 something, I think.
When I went
from 5.2 million. I'm guessing because you're starting to have a little more cash.
1207. Yeah.
Yeah. You're having a little more cash flow from that slightly higher sales price. Now, admittedly, obviously in December you're owing, but you're you're assuming a RFC anyway. So you are getting a little extra cash flow by, having a little bit, holding your margin and holding your cost a little bit lower.
Well, see, I would be careful about that, because that's not the way I would think about it, because I think when you increase your price, I'm still converting my receivables at the same rate. So I'm not probably moving my cash flow in the first 12 years, my incoming cash. And we did an episode on that a while back.
Yeah, I'm a little confused because these are complicated spreadsheets. You're keeping the payment constant. So I'm a little bit definitely not clear on. Somehow it shows different in your, when it converts to your year one free capital, it did go down, not a lot, but it went down. Yeah, 50 grand or something like
people. I'll mark it in orange. This payment right here, I didn't go ahead and explain. It's a little different. It's not used to drive the cash flow. It's just used to kind of do some of these calculations down here, which when we're working with new dealers, Sam, what we do is we say, just think of it this way, because often we're working with dealers who are coming from independent retail or franchise. They've never been around the buy here, pay here business. So this is a way for us to ask them to think about, to cover our overhead, we would need about 75 accounts. So there's another way for us to back up and think about this. At this volume, at 15 sales a month, and at this, cost of car and all this cash flow, we would need about 75 accounts at that 520 a month to cover our overhead. And then we would need about 200, by the time we factor in down payments, we would need 254 accounts all told, paying us that payment of 520 to cover the cost of both replacing the cars and the overhead. So that's why we said 253 accounts. So it's just kind of it's a method to give people a way to think about it.
So then when you raise the price, does that not, this is a question because maybe I'm a little bit unclear. Does that not increase? Does that not increase your cash flow, since if you have the same period of payback?
So if you increased 520.
No. I meant like when we moved, you moved the unit cost down to 6,500, which I think when you're first starting, you're going to try to keep your, obviously I think some people talk about buying 2,000, I'm not talking about moving it down to $3,000. As you said, that was back in the early 2000s. It may be hard to do that, but certainly, there are cars out there for 60, that you can get ready for 6,500 instead of 85. But then the selling price is a fluctuating number. and I think dealers that are mature, new, whatever, talk about it, because that margin is important when you figure, hey, whether you're new or mature, if you have a $3,000 average cost of overhead, well, how comfortable are you, not marking up your car enough?
Sure.
Especially if you don't know what your write-offs are going to be. I mean, that's not a constant number either. Sometimes write-offs equal interest. Sometimes write-offs exceed interest
Right.
payments.
And so what I've done is I changed screens here on just so you kind of see behind the scenes on the portfolio side. So this is what I meant earlier when I referred to conversion rates. And what we do, Sam, is I don't currently, many years ago, I switched away to this kind of a model because I find it's much more reliable when forecasting the cash flow and the yield off of the portfolio. But I think what I heard you say there is what you were really indicating is that if you raise the price and you're still trying to keep your term at 36 months, and obviously the payment's going to go up a little bit, right? So
yes,
that would move that cash flow in that way. And while that certainly can be true, what we're really doing here is we're just saying, regardless of how all that works on you're saying, and regardless of how you choose to amortize the note, then we use these kind of drivers. I call them conversion rate, because what you're basically doing is you're saying, if I open the month, and I don't have it over here at the start, but let's look at like month 2. If I open the month with 176 end receivables, then I should bring in about this much principal and I should bring in about this much interest based on these drivers. So those, I don't change those drivers. And now we can.
That basically, I mean, it's not doing it by months, but your principal goes up as your sales price goes up. So you're 3.5%.
Yeah. And I've said it to dealers before, it's like that's in theory, that's good. It's better to tie this to your actual portfolio performance. You know what I mean? It's
Certainly.
like,
yeah, obviously you don't want to have more repos because you push too big of a payment or whatever else.
Yeah. And so
there's a lot of moving parts in buy here, pay here for anybody.
For sure.
Yeah, that's why there's
a few today. Yeah. And we're not done. Yeah, but yeah, you're absolutely right. But I think this is just to help our listeners kind of understand that's what drives all these numbers in terms of the portfolio, and everybody's conversion rates would be a little different. Part of like what you're talking about, cost of car or selling price of car, terms, and all those kind of things would be a factor. So, but we just find that this is most predictive, most reliable way to do it. And so what we typically do with this is obviously you can tell we have to get custom, and part of the reason that I haven't ever been able to release this spreadsheet, I built this spreadsheet in 2005 and I've added stuff to it as I've, gone, but I can't share it with people because it's not really built to be self-managed. It's like there's all these numbers that have to kind of follow, as you shift the business model. And so it just maybe one day, maybe AI will help me write the thing in a way that we can get there. But it's just there's a lot of moving parts, as you said. And so for us to be able to shift, I think what we'll do is we'll come back on a future episode and we'll break down an organic, like a slow growth sort of model, and say, if I just did my volume slow and I just took my positive cash and reinvested and built my volume a little by little, then we can look and see, how's that look across 5 years,
How does someone do that? Do they do cash sales? I mean, that's a whole nother episode, I'm sure, but do you do a mixture of cash and finance, or, how do people get to a point where they can say, I can start with less than $2 million. I can start with $1 million or $500,000 and make it work.
I think
a lot of dealers do it. I mean, you might need to, say, hey, well, what is it that dealers do to make that work? Where they did start off with, $300,000 or $400,000 and somehow, mature. I mean, in those comment sections, people say I think a lot of people are not going to put out their everything about themselves in a public space, even if it's a private group. But some people do. But I mean, when they say they grew organically, I'm curious what that means. Again, you're not starting with $0, but I would think it means you're not starting with $5 million in the bank either. So
yeah, good point.
Maybe a lot of people did start with $300,000, $400,000. They mortgaged their house or sold other small business or inherited some money or whatever they did, and then they somehow managed to, as you said, grow slower, and maybe they didn't reach, hey, they're not at 500 accounts by year 4, but on the other hand, hey, 10 years down the road, they're saying, hey, you know what? It's working pretty good.
Yeah. And I think the thing that gets left out of that, because we do hear people say that they, I think a couple of quick things to come back on what you said is like, how do they do it? Well, they either sell some cars for cash or they have some other streams of revenue, right, to support what they're doing or offset some overhead, or they're selling paper.
Yes, some people, yes, they use other forms of leverage that maybe are not.
Yeah.
Or I don't even want to call it leverage, because when you sell the paper, it's not
Right.
leverage.
Right.
It's other forms of getting capital that are out there.
Yeah, there are definitely examples of dealers out there who have done that successfully and worked their way to a place where they could afford to fund the paper themselves. And so that happens. But I think, we work with dealers that are new. Sometimes they're coming out of independent retail. I can think of a dealer we worked with who had a very successful service department. So their ability to add a few buy here, pay here sales, the actual cost associated with them adding that quote unquote department was pretty light. And so when you look at that, that's why
you have like revenue from a different
right.
business. A lot of dealers probably have that, either service or some other business entirely, potentially.
Yeah. That's why I think these conversations are so important, because I just think it's hard to get apples to apples. So what I try to do here, and I appreciate your question, because it kind of inspired me to make the time to dig into some of this stuff and break it down. One other thing I did this morning that I can thank Sam Epstein for the rest of my life for finally making time to sit down and produce this, because I've been wanting to kind of chart this for the longest time, and I'll eventually improve the way it illustrates. But what it's showing is, based on the numbers we currently have loaded, this is what I would call uncovered expenses, Sam, this green line. And so what that means is, and here's the way I chose to do it. Let me back up and help people first understand. The green line is basically just saying our operating expenses net of collections. Okay. So all the stuff related to sales is up in the blue line, but this is just saying the cost of operating, which I have even the overhead. I have 30 grand of just opening the doors, signage and lights, software and all the stuff. I got 30 grand in there. And so that's why month zero looks like that. That's what I call pre-start expenses. But then we would have to fund this. We would need about 123 grand to cover the expenses at this low volume that we've got in there. We would need 123 grand just to cover the expenses until our cash flow built up to the point that it covered those expenses. So when I say cash flow, principal and interest collected plus the value of any repos we recovered, that's going to be kind of yield from the portfolio, if you will. And then if I look at inventory, I choose to drive inventory based on net of down payment. And my thinking on that is, we don't have to replace the car unless we sold it. And if we sold it, we got some down payment. So this number up here is the amount of money we would have invested across 12 months. So in this case, 1.3 million, we'd have invested just in replacing cars, even after we adjust our down payment. So I just kind of broke those out into two different numbers. And so obviously the sum of those two numbers would be reflective of our total capitalization. So it's, and I don't have income tax built in here because none of us want to think about income tax, but it's like, we realize that it's part of why I think it's an ongoing conversation. And again, I'm just really grateful for you, throwing the thing out there, because I thought it invoked some thought, which is always good. And it kind of showed, as people responded, man, business approaches are just all over the place. And it's part of what attracts people, I think, to buy here, pay here, is the beauty of being a maverick and creating your own model and doing it the way you want to do it, and whatever you have the appetite for in terms of risk. And some use leverage and some don't. And it's just kind of fascinating to me. And we can take down the spreadsheet. I think it just is indicated. And I think, I obviously enjoy playing with the spreadsheets and playing with the, working the levers and see what it changes. So it's
I can vouch for that.
Yeah, it's
Absolutely.
fascinating stuff. But and I think for today we covered what I had in mind to cover, and I would urge you kind of, keep tabs on what we're doing with the cash flow modeling that we do forward, because we'll continue to analyze this. This is just such important stuff for people to be able to grasp, and especially now with cost of car being higher, it's just we are. And cost of money is higher. So this just means our what's going to require us in cash is going to take more. And our margins for dealers, whether we're talking about profit or cash flow, our margins are thinner. And so we've got to be, pretty careful about how we model and build our business plan. So I think it's useful.
Yeah. Well, I think the margins, as your cost of car goes up, tend to go down, which is kind of one reason why I said, hey, like that 8,500, I don't think, some people say, oh, go buy a 2000. Well, you don't want to buy, $2,000 car if it's not going to run for 3 years.
Right.
But buying a $5,000 car that you can recon, an extra 1,000 into, and, maybe it's not quite as pretty or whatever. Maybe it's got a scratch or two on it.
Yeah.
That can have a huge impact on your overall success rate if you're dealing with a limited budget.
Sure.
Because you may be getting $1,000 to $1,500 as your down payment, whether you have 8,000 or 9,000 in the car, or 5 or 6,000 in the car. And to that point too, also people's payment, people can only afford so much a lot of times. So, if you look at some of the bigger companies out there, like, Drive Time, or, America's Car Mart, they're a public company, and you can see, they publish their numbers, and they have over 100 stores, and they, during COVID, they just allowed their cost of, ACV, cost of goods, to balloon. And they went from selling cars that were, 12 or 13,000 to 18,000, and their margins went way down. I mean, their gross margin now, I think, under 35%. And they used to be kind of like a pretty, well run as far as holding, 45% margins or that kind of thing. For having 100 stores, I mean, that's a huge difference.
Sure.
But you can't make the payments go to $1,000 a month on a buy your pay your customer.
Right.
No.
Right. You can, but they won't be out there very long. So
That's true.
Yes.
No, I appreciate you making time, Sam. We should wrap up there, but it's been a pleasure to meet you and spend some time with you. I appreciate your question and your contributions to today's
we'd love to
conversation.
be able to invite you back again in a future time. We
plenty
really
more
appreciate.
subjects,
There'll be plenty more subjects.
But again,
you've got a lot of a family experience of a few decades, and so that's always adds to a really rich conversation.
Thank you. I've never been on a podcast before, so I hope I
You did great.
You did great. Thank you so much. We appreciate.
All right, do you want to stick around behind backstage
stay with us for
so we can say goodbye properly before you go?
Okay, sure. Thank you.
All right, thank you. All right.
So fun stuff. I love digging into the numbers, but I think I will plan to make Fridays for a time until we feel like we've
I do. We use this tool all the time. I say we.
Yeah.
She uses this tool all the time.
Analyzing.
And it is something that we have seen that it's possible for people to go from with very, very low amounts coming up, but it's certainly challenging in a very different way. So I look forward to actually unpacking that a little bit too.
And listen, I'll remind folks, we got our new Group 3 is a brand new dealers. If you're new in the business, like under 100 accounts, some of our dealers will be under 50 accounts. Just reach out to me. Let's get this talk. We might do cash flow modeling in that meeting on Tuesday night.
Fun.
So,
all righty. Everybody, have yourself a great weekend. We appreciate you joining us today on this Friday, and we will see you all on Monday. Have a great day, everybody.
Thanks. Have a great Friday.
Thanks so much.